The latest real estate sector IFRS financial statements survey has just been released. I'm Victor Chan, and I have Matt Williams with me today, who's going to go through some of the major findings of the survey. Matt is a partner with Ernst & Young LLP in the United Kingdom, and he has been a main contributor to the survey for the past many years. Matt, I know that the survey covers IFRS financial statements published by real estate entities from all over the world, including those in the Americas, Asia Pacific, and Europe. Can you tell us more about the survey?
Yes, hi Victor. So we took over 50 sets of financial statements, as you say, across the world and in the real estate sector, and we looked at them to understand what the latest trends are in financial reporting for real estate. Of course, we know that annual reports and financial statements are important because they allow investors to make the right decisions about where to deploy their capital, and those returns are what pay for our pensions, for example. So it's really important to understand those financial statements.
Did it take long to prepare for the survey?
A bit of time. And one of the things we did notice was actually over the last few years, the documents themselves have got a lot bigger. They went up from about 170 to a little over 190 pages on average. There were some significant differences within that, but the trend to larger financial statements is clearly there. And whilst there are some jurisdictions where the regulators have tried to encourage the preparers of the financial statements to make them concise and focus, there is a constant need to focus on that, given that's normally accompanied by new accounting standards and new regulations which tend to increase disclosure. So keeping accounts focused so that readers can really understand the key elements is also really important.
That's helpful. Maybe we can move on to the next question. What does the survey tell us about the valuation of investment properties?
Well, IFRS, under which all these accounts are prepared, gives you two options for investment property. It says you can either measure them at fair value, or you can use measurement based on cost. We found, perhaps unsurprisingly, that about 90% of the preparers used the fair value model. And this has been consistent for a large number of years. That fair value has been a really predominant model. Not all do. I think there are 4 entities in our survey that did use cost, but actually they have to disclose the value of the properties in any event. So it's clear that valuing properties rather than measuring at cost is the overriding accounting treatment.
So how do these real estate companies approach those valuations?
Well, the first thing we did is look at who did the valuations. And whilst IS 40, which is the standard for investment property, encourages use of an external qualified independent valuer, it doesn't mandate it. But we found that the majority of preparers did use an external valuer, albeit not all of them. There was some mixed practice. Management in some circumstances valued some of the entities, and those who did that typically described what those properties were. Others did almost like a review of the external value and did their own valuation on top. So there was some mixed practice, although predominantly external valuations came through. Only 4 entities didn't use an external valuer at all, and those were the same 4 entities that didn't use the valuation model that I discussed earlier. Mm-hmm. So there was congruity between those 2 items, which I think you would expect.
And did you see any dominance of valuation models used by real estate entities?
Yes, and this is where the UK was quite different to other jurisdictions, actually. So broadly, there are 2 valuation models. A DCF, discounted cash flow, or an income capitalisation. Now, a DCF is much more explicit in the way it models future cash flows and much more explicit in the way it builds up a discount rate. Whereas an income capitalisation model at least the proponents of it would argue it's closer to the market because it's seeking to use observable yields, for example. That's a matter of opinion, of course, and we do know that even in the UK, the RAICS, the Royal Institution of Chartered Surveyors, are encouraging now UK valuers to use a DCF model where it's more appropriate. But at the moment, it seemed to be only the UK which focused on this income capitalisation model. The others were using a DCF.
But it really looks like there's not a real preference, but it's just more like a market practice. Or the predominant model used doesn't mean that one of them is better than the other necessarily.
No, that's entirely right. You are, of course, obliged to use the model which a market participant would use. And so that does vary, exactly as you say, by jurisdiction.
If we take one further step into the inputs of the model, what did real estate entities disclose about those inputs?
Right, so luckily IFRS tells a preparer that they should disclose the principal unobservable inputs. And as you might imagine, and as we've actually consistently found over previous surveys, the key items there are the discount rate or the yield if you're using the income cap model, the market rent, and rental growth. Clearly those are the unobservable inputs you would expect, and that consistency has been there for a number of years. On the slide we prepared a table just to show, to emphasise that. And then we went to look at the sensitivities. Now, IFRS tells you that you should provide a sensitivity. You should understand or estimate what a reasonable range of those inputs would be, and then disclose what the impact on the valuation would be if you'd used one of those other numbers in your reasonable range. And actually there's a wide range of reasonable ranges. For yields or discount rates, there was a 25 to 100 bip range. For market rents, there was between a 2% and a 10%. Now, clearly that means it's quite a judgmental thing. It's going to depend on jurisdictions. It's going to depend on your asset. But it was interesting to see how many different judgments have been made by different preparers in those sensitivities.
Maybe we can move on to gearing, which is focus for investors and users of financial statements. So can you tell us something more about how gearing of real estate entities has changed for the past years?
Yes, and this was actually something of a surprise to me because we know in the generality that property values have been falling for a couple of years. But even so, we found that actually gearing had also come down. I think we used debt to equity, and it had reduced on average by, I think it was 93% to 89%. So in the context of falling values, if you've also got falling gearing, that must imply that a lot of these investors have been very actively trying to control their gearing, control their debt levels. And so that's a really interesting finding for me, at least.
So that looks like it's quite a bit of de-risking in the market right now.
It looks that way, yeah, which tallies with my understanding or understanding of the market. But to see it actually happening it was a really interesting finding.
More about gearing. Yeah. Gearing for real estate entities is usually subject to covenant restrictions. Yes. What do you see in terms of entities' disclosure about their compliance with financial covenants?
Yes, again, we're helped here because IFRS encourages, or in some cases requires, disclosure of covenants. And we found 40 out of the 51 entities in our survey did disclose information about that. Now, some of that was only to say that there are no breaches of covenants during the year. Some made more detailed statements about what those covenants actually were, and some actually went on to give headroom. So there was a wide variety, and it did seem that the more detail was given by entities perhaps where there was less headroom on the covenants, sometimes crossing over to their going concern disclosures where they talk about what the future might look like. So yeah, a wide variety. But to my mind, covenant disclosures really useful, really important to the users of the financial statements to understand the financial stability of the entities they're looking at.
Maybe we can then move on to valuation. One common question about valuation is whether an entity's net assets under IFRS would be close to the market capitalization of the entity. What do the survey results show, Matt?
Yeah, and that's a great question, actually. Whilst IFRS isn't designed to plot the company's market value on the balance sheet, a lot of people would say, okay, because you're valuing the principal assets, you'd expect there to be some correspondence between the IFRS net asset value, the NAV, and the market cap. But actually, there's long been this phenomenon in the real estate business that there's often a discount between the two. And we found exactly that. We found on average, and this is only based on the snapshot or the data we had at the time, on average, the IFRS NAV was 74%. The market capitalization was 74% of the IFRS NAV. Now, why would that be? Why would the market capitalization be lower? Well, there's a few things going on there. Of course, not everything on an IFRS balance sheet is going to be measured at fair value. Debt typically won't be. Other things like deferred tax typically won't be. And of course, the equity markets have a number of other things going on in there. So the market capitalization will often depend on the liquidity in that particular stock or share. It will depend on the overall sentiment of the market and perhaps investors' confidence about the future. So there's a lot of things going on in there, which often leads, we found, to quite a big difference between the IFRS NAV and the market capitalization.
Another common question I've heard about is about goodwill. Can a real estate entity have goodwill on its balance sheet?
Well, it turns out it can. For those who are not sure what goodwill is, this is a difference between how much was paid for a business and the value or the individual fair values of the assets you put on balance sheet. And a lot of people say, okay, when you buy a property business, are you not just buying the underlying property assets? Is there anything else in there? And I mean, that's normally a good challenge. But what we found that there were a number of companies who had actually identified value elsewhere that they'd paid for. And IFRS tells you, you need to describe what that is. And we found that a number of them had ascribed value to the future profits that they're expecting to make from asset management teams or property management teams, or indeed development teams. The profits that weren't already factored into the value of their existing property assets. There was one particularly technical point, which was where deferred tax had caused goodwill, and that was really to do with a mismatch between the measurement of certain accounting standards. And that's sort of well known, and it crops up from time to time, and is one for the technical accountants.
Indeed. Well, in addition to numerical amounts, IFRS also requires entities to disclose significant estimates and judgments underlying the financial statements.
Yes.
How do real estate entities achieve this?
Well, let's take them one by one. So for estimates, and this is actually a relatively straightforward one, and it probably doesn't surprise you to know that the key estimate that was disclosed was that of the property valuation. Or if properties were held as inventory, which would mean cost, then actually the net realisable value. Similar sort of concepts and similar estimation disclosures. So there were other estimates in there as well. Some provisions, for example, were estimated. I think one or two talked about share-based payments, the estimation with those, but unsurprisingly dominated by the valuation of property. The judgments, much more diverse, as you'd probably expect. So common ones were judgment around what sort of interest the parent had in other entity. Did it have a controlling interest, or was it a joint control, or was it significant influence, which actually leads to different accounting answers in the group accounts. Similarly, a judgment on the classification of property. Is it investment? Is it operational, which would mean it's plant and equipment, property, plant and equipment, or is it something they're holding for sale in the short term, which would be inventory and IS2? And those give you both different accounting classifications, but also different accounting measurements. So you often see those being disclosed as significant judgment, which must be right. It must be right. So those are the two key judgments. There's plenty of others out there as well, but those are the ones which dominated.
And looking beyond financial statements, can you highlight what disclosure entities make in other parts of the annual report?
Yeah, the one that really shone through are what's known as alternative performance measures, or APMs. And these are numbers which are based on IFRS, but then have various adjustments to them to give a number that the preparers of the financial statements think are of use to the users. Often these are framed in terms of KPIs, for example. And a lot of national regulators have put guidance or restrictions about how APMs can be used. For example, they shouldn't be more prominent than IFRS measures. They should be consistent and they should be clearly explained and grasped and grounded in IFRS. Probably the best known example, at least for this survey, is the European Public Real Estate Association best practice, or the BPR, and that contains a suite of these APMs. And 37 of the entities in our survey either gave some or all of those APMs. And for those who didn't, who gave perhaps their own APMs, a lot of those were very similar to the industry the common industry APMs. The other one we found were the 4 South African entities, all gave the South African REIT Association metrics consistently, so that was also interesting to see. Others gave the funds from operations was perhaps the other one that stood out, which is sort of derived from US GAAP and maybe the NAREIT metrics. So there was a bit of a variety, but the EPRA BPR were the ones that dominated, perhaps unsurprisingly, as a lot of our survey were from European companies. Probably also helpful to add that when we see IFRS 18 come in the relatively near future, that describes MPMs, management performance measures. This is a subset of APMs, but we'll probably see the disclosure and the presentation requirements of IFRS 18 probably be more widely adapted for other APMs. So I expect to see, if not a seismic shift, at least some change about how these things are presented in the future.
Well, so we only have enough time for one more question, but I think this is an important one. What do you see from the disclosure of entities about their ESG targets and policies in the annual report?
Yeah, well, we did look at this. It's actually really hard to compare because a lot of the regulations around ESG disclosures are actually set by different jurisdictions, so very hard to compare. So it may be this is a whole new topic for a whole new survey in the future. But what we did see was a growth in financing arrangements where the pricing was similar, had links to certain ESG targets. I think it was 27 entities had such. Most commonly pricing linked to energy efficiency or emissions or a requirement to invest in sustainable projects. Again, that was also a really interesting finding to see that at least half, or a little over half, of the entities had actually grasped those, what are often called the green bonds, and were using them. And I think that just marks, the sea change we're seeing in the way sustainability is a really important factor in the industry now.
Matt, thank you very much for sharing the insights about the survey today. And for viewers of the video, thank you very much for joining us today. There is a detailed slide deck about the results of the survey, and it could be accessed or downloaded following the instructions of this video.